So it's done.
Awesome. And everybody can see my screen now?
Yes.
Yes, Karthik.
Brilliant. So welcome to today's session. The session is about getting investment ready. So all the things you want to do before you start meeting investors, or all the things that you should be thinking about if you're thinking about meeting investors, right? And so it's more about your frame of mind, if your preparation as you go out and start thinking about a fundraise. And so when you're going out and looking for investors, first things first, do as much research as you can on the investors that you would like to speak with. For every startup out there, there is a certain set of investors that are also looking for you, right? So I think sending investor who only invests in software companies, a land restoration idea which has no software built into it might not be a interesting conversation to be had. So kind of make sure that you understand what the investors' interests are, if they have done something before, or at least expressed an interest to learn about what you are doing in the past, right? And so if you're raising capital from others, it's a very important step in your entrepreneurial journey, but it's not anything more than a very important step in your entrepreneurial journey, right? So it's not like it's a milestone. It's not the only thing that you need to kind of be focused on. So make sure that you're spending enough time on your business and prioritize your business versus fundraise, because fundraise takes time, right? But if you're at the point where you're thinking about raising money, which is basically the point where you're at number 4, where is the money? You need to have the answers for who's your customer, who will buy your product, why would they buy your product, how will you make money selling them and servicing them? And then you can get to the point where you're talking about where is the money, who would fund my business, right? And the main reason you want to raise money, and not every business needs to raise money, but one of the reasons to raise money is to survive. So, basically you have cash shortfalls, you want to fund that. And maybe you want to grow, so you might not have enough capital of your own, or like capital coming from your business to kind of fund your business. So you want to kind of raise capital, right? A lot of businesses that run out of cash haven't thought about where their money is coming from beyond sales. So which basically kind of creates a lot of problems when things aren't going well, right? Or things are going really well, then we run out of money. I think we talked about what growth can do to your startup in our last session. So when you're talking about finances, again, this is from my last session with you guys. What you need is to be able to explain your historical and current financials and be able to support your future assumptions, right? So don't try to fix your historicals. You just need to be able to explain it, right? What happened, why it happened, how is it going to be different? What went well, what did not go well, how did you handle it, stuff like that, right? So everything is a story. You need to kind of focus on that, right? And when you're making projections for the future of your business, try to make projections of your business without the investment, right? So you're today running your company, you don't have an investor on board, or you don't have a new investor on board. What's your plan? How does your company look like? And then put together a plan which says, hey, if I had capital, I would go out and get more customers, more business, and my revenue trajectory would be different, right? So your revenue trajectory, your business growth potential should improve with new capital coming into the business. That's the important part that most investors are looking for, but they're also looking for, if you didn't raise money, what would happen? Right? And a lot of investor conversations take a few months, and they would like to come back and check in with you what happened last quarter or last month, while you were still waiting for the money to come into the bank. Right? So again, so to summarize, in terms of financials, I'm sure we'll go and look at financials, valuations, stuff like that. But on your financial model, the most important thing is to make sure that you tell a good story about how you're building your startup. Um, in terms of the other big one that you want to kind of focus on before you have a first conversation with an investor is basically your market size. So we will hopefully go through action. I don't know if we can confirm this, but we should go through a market sizing exercise, trying to understand how you build your target market, your addressable market, and you should be able to kind of define that and showcase to an investor that this business and this market is a very interesting place to operate, right? And make sure you can explain it to them from the ground up. What I mean by that is to break down how you came up with the market size, right? So here, what they're talking about is, the overall capacity that's available, say on a plane, how much of it is available to be filled up, what's the price, and all of that multiplied together comes out to a market size for the cargo market, right? So build it from the ground up. Obviously, you will get market research reports which say your opportunity for spices in India is like $5 billion, and then you want to capture like 1%, but that's not what you want to kind of be talking to an investor about. So talk about what specific opportunity within a market you are capable of capitalizing, and not just talk about a generic market from a market research report and some percentage of that market that you're going to capture, right? So be focused, be very clear on what's the opportunity that you're kind of picking up, right? Now, for startups, this one I think is my most valuable feedback that I can give you. If you have sales, some sales, but you don't have traction, and we talked about this concept of minimum viable traction last time. If you're not growing month on month, if you don't feel like you have control over how you're growing your revenues. Every month, I apologize for my daughter in the background. If you have like sporadic sales, you're doing pilots, all of that, right? Don't declare revenues. Don't say you're a revenue post-revenue company. So whenever you come to an investor, they'll be like, are you a pre-revenue company or are you a post-revenue company, right? A post-revenue company basically is growing month on month, quarter on quarter. If you're not doing that, then you're not a post-revenue company. And don't be in a hurry to call yourself a post-revenue company. Just call yourself pre-revenue, and you're at you're kind of showcasing a very high potential rather than kind of saying you're post-revenue and then you can't show that you have traction, that you have control over, because then you're just an SME which may not grow too much, right? So in your financial model, in your business plan, the most important thing that you're showcasing to an investor is your assumptions. And those assumptions demonstrate your understanding of the business, right? Do you know the business you're in? Like, what is the EBITDA margin? What is this gross margin that you expect? How much does the distributor expect to get in terms of margins? All of those things, if you're in the business, you will know from just experience, right? And that's what the investor is looking for. Are you in it? Are you basically understanding the dynamics of the business you are in, right? Keep it as simple as possible. So focus on the growth drivers. We talked about that last time, and then basically focus on the cost drivers if you are kind of getting into a traction mode where you want to also manage for costs and optimize things, right? But just focus on the business critical items. Rest of it is not important, right? The only other thing I would add is like focus on your team, because in the early days, investors are investing in the team, right? Figure out milestones that you're looking to achieve and look for funding to the next milestone, right? So every time you go out and raise money, you want to raise money when you have good news. So you have a milestone that you have achieved, go out and talk about that to the investor and kind of get to the next milestone and ask them for money to get to the next milestone, right? That's what they're interested in, because they can then evaluate how much of an improvement you as a company will have in terms of value. And every time you get to a new milestone in your business, you reduce the risk. And as you reduce risk, you improve the value of the business. So if you're not having revenues, don't fret about it, but kind of define milestones that reduce the risk in your business, and then talk about the milestones that you want to achieve with the capital that you raise from an investor, right? So the only bit that every time we hear from startups or entrepreneurs is, I am seeking a certain amount of investment in exchange for some percentage of equity in my company, right? And there's a lot of like these terminologies that are kind of thrown around. One is obviously called the pre-money and post-money valuation. The post-money valuation is the value of your business after the investment, right? So that's what your business is valued at. So that's typically what's called valuation as well. And then the investment is typically called new money, because that's money that's just coming in and being part of your business going forward, right? So the question to you is, when you basically get new money into the business, the money is going into your company, right? And so you issue additional shares. So it doesn't come to you. You're not selling a part of your business yourself. You're just basically diluting your business ownership to a new investor, right? So the question for you is, what comes first, right? Is it the pre-money valuation? Is it the post-money valuation? Is it the investment? Is it the investor ownership? Like, what do you think gets figured out first? I would ideally like more than a few people to answer that question. So please feel free to unmute yourself, and otherwise I'll just have to have Ashna call you out.
We've got
I
five.
think- Yeah, we got somebody in the chat, Tanmay, who's bold. Mhm.
Okay, Rudransh has an answer.
Hello. Yeah, hi. So sorry. So basically, the pre-money valuation should come first, because because it is not certain at in the very first round of a company that how much amount does the company need to raise, because during raising the amount also they will get to know that there would be certain changes that have to be accommodated in the round itself. They could have planned the round of like 1.5 cr, but the company needs 2 cr at that moment for that round. So that is why it is very beneficial to do a pre-money valuation and then go to the post-money or the investor ownership on that part.
Okay. Hari Krishna. Since you have your video, I'm sorry.
Hari says it is investment.
Hari says,
Yeah, he has written in the chat box.
I just guessed it.
We've got two more pre-money valuations in the chat box.
Amlan and Rupali.
Okay. So everybody has. Okay. So Hari, I think you get the prize. So the thing that comes first is investment, right? So that asks. So the bit that's kind of feels like, hey, do I need 1 crore? Do I need 2 crores? Is the investor ready to give me, 2 instead of 1 crore kind of conversation, right? So the bit that comes first always is the investment amount, mainly because that's the bit that you can actually justify to an investor, right? Your business plan provides the investment amount, right? And the bit that comes last actually is the pre-money valuation. Yeah. So when you kind of define the investment and then you create a business plan and a financial model, all of that kind of provides you with the valuation of the company after the investor has put in the money into the business, right? So the business plan that you are kind of using to value the company is the business plan with the money, where the chart was going more upwards compared to the no money business plan. So you're using that to kind of value your business. And so the first thing you get actually after you put in the money is the post-money valuation, and the pre-money valuation and the ownership both come as a result of knowing the investment and the post-money valuation, right? So you take the investment amount out of the post-money valuation to get the pre-money valuation, and you divide the investment amount by the post-money valuation to get the ownership, right? So the bottom two are derived numbers. The top post-money valuation is actually a calculated number, and the investment amount is the only number that you can really have a conversation around, right? And so the good thing for you as an entrepreneur is the amount of investment you see is defined by the amount of investment that, again, you can make an investor believe is what you will use well, right? So you will see entrepreneurs who raise... Sorry, go ahead. Do you have a question or a comment?
Kanchan, you have to mute yourself.
Oh, okay. So I think the bit to kind of remember is, again, your ask is also something that you can improve upon, right? So do you want less money so that you don't get diluted too much today, right? Can you figure out getting some grants? Can you figure out hustling up some partnerships so that you don't need as much money, right? Or can you basically have a more ambitious plan where you can have better growth prospects or faster growth prospects, and that justifies you being able to raise more money, right? And that might basically give you a better valuation, maybe, so you get the same amount of dilution, but you get more money into your business, right? So all of those are possible, but the main thing is your investment ask and the plan that basically justifies that investment ask that goes with it. Yeah, I think I need to go a little quicker, right? So that investment ask is basically your use of funds, right? So it's basically the money that you're going to spend on R&D, customer development, all those kind of long-term things that might not immediately kind of generate revenues. Then the stuff that you spend on growing your business or improving your revenues, which is typically sales and marketing and working capital. And then the bit around survival, where if you didn't do anything, you would still need to pay those, which are salary and rent and cash burn, right? And the bit that you typically want to kind of have an investor fund is your money that's left over that you can't fund from other things, right? So if you have working capital financing, that's something that you can take out of here, right? If you have money from somebody to do R&D, or if you have an R&D partnership, so you don't need money for that you can take out of here, right? So all of those matter. So what you want to get to is figuring out what is the peak money in the bank that's missing when you make your financial models, to say, hey, if my business keeps going according to this plan and I have some level of cash today and I keep doing this business plan, at some point your cash in the bank will go negative, right? Because you're growing or because you're basically using up your cash in other things in your business. And then that negative cash keeps going negative, and then it will start coming back up. Right? So as your business improves, you have economies of scale, all of it will come back up and go positive. But that dip in the cash, you want to kind of fund the deepest dip in the cash. And if you get that money in the bank, then your financial model basically doesn't have a negative cash balance, right? So that's what you're basically funding. So typically in a financial model, you don't need to do a valuation yet. You just need to kind of make a financial model of your business and then see how much of cash you have in deficit and basically fund that. That's what you're looking for in a fundraise. Yeah, and you need to be able to explain that. I think I just went through what comes next, which is your post-money valuation. So the most important few things do your homework. So talk to people, find out about who are the investors who would be interested in talking to you and working with you. Reach out and network with as many people as possible who can help you, because a lot of the work that you do is about using your networks to get them to connect you to the people who matter, right? So programs like these, but all other opportunities you can have to network will really help you connect with the right people for your funding, right? And so talk as much as possible about execution, and talk as much as possible about your team. Yeah, I'm going to stop here, and I'll take one or two questions, and then we'll jump over to Anisha, and then we can come back and take more questions.
Amlan has his hand up.
Yeah, I have a small question, because you said that don't project ourselves as a pre-revenue, but honestly, I mean, we have been in a very, I mean, I should not say early revenue, but we have been doing pilots, we are doing paid pilots, we are trying to survive. So we have received grants, and we have been using as a revenue and trying to develop business. So what do you do about that? I mean, we have raised about more than 77 lakhs, in last 6 quarters. So how do I place ourselves?
You say that you have early sales, right? So that's basically what I'm trying to explain to you is revenues when it comes to investors is basically sales that you can project or forecast month on month and be in control of, right? So if if you invest in the stock market, every company that's public needs to, announce how much of sales they're going to do in the next quarter or next year, and what kind of profits they will make in the next quarter or next year. And if they don't hit those targets, they get penalized, right? Their stock goes down, right? And a lot of the CEOs, if things are going bad, will give you like warnings saying this year we won't make our targets, and then the stock trades down. So it's basically your ability to project and your ability to kind of hit those projections, which is what is the definition for revenues. If you're selling, some amount this month, and then you hope that you will sell some amount next month, but you can't tell with surety how much, or like some level of surety, how much you're going to sell next month and the month after that and the month after that, then you're not in revenues. Don't call yourself revenue. So don't use the term revenues at all, right? Just say sales, right?
Thank you so much, Karthik.
Do more sales.
You have made it so very clear. Thank you so much. So early sales is the right terminology, and I consider that. Revenue means when I have a very concrete idea what's going on. Right, yeah, I mean, very honestly, we still don't have. We are only having a projection and prediction. Okay, and most of the times things doesn't work out the way we think. Farmers just behave very differently when it comes to picking up the material. They say a lot of things beforehand, and we have been facing it. So you are very right. We still don't have a very stable plug and play model where we know that, we go there and it will churn up this amount of revenue. Okay, understood. Very well explained. Thank you so much, Karthik.
Sure thing. One more.
Tanmay has his hand up.
Hi, thank you, Karthik. So I have 2 questions. One is for an early stage starter, for how long is it expected for them to project their negative or the cash flow deficit? And like how many years into the future is that expected that you have to project your cash flow deficit? And yeah, that's the only question.
So I think you want to project it till the next milestone that you want to achieve, plus say, depending on how good or bad your investor interest is in your startup ecosystem, timeline for you to raise money, right? What I talked about is you hit a milestone and then you go out and start talking to investors about that milestone and then, raise money to get to the next milestone, right? So the time between you hitting the milestone and the time for you to get the money in the bank also you need to kind of cover in your fundraise. So basically, if you've hit a milestone today, you want to fundraise for the time you will take to get to the next milestone plus the fundraise period after that, right? So I would say that could be anywhere between 6 to 9 months. So if you have, and don't make it too long a period. So 18 to 24 months is as long as it gets in terms of between fundraise periods in most investment circles. And Anisha can give a different background as well on that.
Sure, perfect. Thank you.
Amlan, you have one more question?
Karthik, we have some questions in the chat box. So Archana wants to know, are there any best practices or suggestions to arrive at valuation of company?
Yeah. Are we not going to have a session on valuations anyway later?
We can schedule one.
Yeah, we can maybe do one for the in-person event.
Yeah, so I think valuations are very specific exercises that you want to go through. And so, yes, there are lots of best practices. There is a lot of people who provide assistance. A lot of your investors will also help you come up with a valuation, be able to kind of discuss that with you. But it's a critical part. But I think the easier one to do before you get to a valuation, because valuations at the end of the day are more art than science, right? Or math, really. So I would focus on things that you have very good concrete control on, is how much money do you need based on your business plan, and maybe having some options on, if I had less money, what would my business plan look like? If I had more money, what would my business plan look like? Right? Because you will meet investors who say, oh, I don't do 1 crore investments. I at least need to invest 3 crores, right? You have a business plan that will use up 3 crores, right? Can you basically improve on your business plan to accommodate more capital, right? The same thing, somebody might come and say, hey, I have 50 lakhs. Would you like to take it now? Right? Will you be able to accommodate that in your business plan, right? So being able to be flexible. So I think somebody talked about like what happens if I have less investment coming in. Your business plan should accommodate different amounts of investment asked. And that has nothing to do with valuation at the end of the day, right? So being able to do that first and foremost and being very good at it is a lot more valuable than being able to do a valuation exercise. Right? But valuation, somebody said, is important. I agree. And we can go through that in more detail today. But I think today's focus was around kind of getting into investor conversations and what investors might be looking for in terms of diligence, right? And initial diligence from an investor is basically about understanding your business plan and if you have a meaningful investment ask. Those are the two important things to kind of get into when you're talking to an investor, and being prepared with those backups of being able to explain what you've done so far and what your plans are going forward, right? Kavita, can we jump over and have a...
I was about to say that maybe we should go to the next part of the session and we can take up the questions later.
Yeah, and I can stick around for a little longer.
Sure.
And maybe I'll just answer a few in the chat.
Karthik, you can also stop sharing your screen now.
Oh, yeah. Stop share.
So we have 2 more questions around valuation only that we will be dealing in a another session later. Amlan, do you have another question?
Kavita, maybe we can take
No,
all the
sorry, I
questions later and can hand it over to Anisha now for the
Sure.
second part.
And I'll go through the questions in the chat box to take up later.
Anisha?
Okay, great.
Yeah.
Thanks.
Got it.
Thanks, Casey. As always, your presentations are extremely insightful. It's just that I have to follow up that with my boring one and more technical one. But hi, everyone. Good evening. Great to be here. Given the paucity of time, I'll jump directly into the presentation, but just wanted to let you know rules of the game are pause me at any point of time if you have any questions. The idea of this session is to kind of make it as interactive as possible. I will be touching on very high level initial DD questions that every investor asks for. We'll obviously, if I were to go into the details, it would take forever. So yeah, let me just share my screen. Sorry. Now, we all read about all these startups raising multiple rounds of investments, becoming unicorns, and it's all a very fancy and attractive stories, but no one talks about the quantum of work and agony and details that go into each fundraising process. And the startups actually have to go through a lot of steps to actually see that money in bank. This is typical investment process, right? You know, from the time you pitch to the investor, there's a commercial diligence and valuation, which Karthik talked about. Once that is done, once you've convinced the investor on the quantum of investment you need, the pre-money, post-money, all of that is finalized, is when you get a term sheet. And once you sign the term sheet, the investors, lawyers and financial consultants basically will swoop right in and review all your books, all your documents and filings threadbare. And that is the due diligence process, which I will be focusing on today. While that is getting done, you will also, you know, the term sheet that has been signed with the investor will get elaborated into extensive documents, because I mean, even lawyers need to make some money. So that's what happens. Once the definitive documents are done, and the diligence is completed, from the diligence, anything that's highlighted, right? Any filing missing, any contract that's absent, anything that the investor wants you to do, the investor basically puts it in the document and says, hey, these are the CPs, conditions precedent. So the investor puts this entire list of conditions and says, fulfill them, and then I'll give you the money. Because they all know that before they give you the money, if they ask you to do something, you'll finish it. Once the money is in bank, you may not even take their calls, which is why there's a long list of conditions that investors put in. And that is why it's important for you to be investment ready, be ready for due diligence, so that your list of CPs are lesser, shorter, and so that the time taken by you to get the money in bank is short, right? Because typically the process from pitching to the investor till you get money in bank, in a best case scenario could be about 2 months, but worst case scenario can go up to even a year. And I'm not kidding you. The biggest roadblock always in a fundraising process is due diligence, because most of the time the company doesn't have documents in place. So it takes almost like 4 to 6 weeks to get documents in place. Then the investors, consultants review them. Then there'll be a ton of things missing, fixing them. All of that can take forever. And this, obviously, I don't have to tell you, Karthik has already mentioned it. Imagine if your deal takes 6 to 8 months or even 12 months to complete. You blocked your valuation a year back, right? obviously the company's been doing business in the meantime. So it's really not in your interest to, stretch the transaction timeline, and therefore it's important to be investment ready at all times. Now, what is it that investors look for when they're carrying out a due diligence, right? Basically, a due diligence is a legal audit of all your books, all your filings, like I said. So principally what is being checked is if your entity is properly set up, if your business is in compliance with the law, if you have contracts, then, the extent of obligations in the contracts, how much risk exposure, like if you're in a business where you're giving warranties on your products, which are like for 3 years, 4 years, that's a huge thing. If you're giving, cashbacks, that's a huge thing. So investors need to understand what kind of contracts you have and what is the risk exposure, because ultimately they don't want to give you money and realize that money is spent in, satisfying some warranty somewhere. And of course, to understand who all have you promised equity to. So this is typically what we look for when we are carrying out a due diligence. Somebody did ask for a DD checklist. We can share one, but typically these are the headings that any standard DD checklist that an investor sends you will have. Your business and holding structure, right? Organization structure, general corporate information, your shareholding structure, all the filings you have done, who are the directors, who are the shareholders, who have you borrowed money from, if you have, mortgaged or hypothecated anything, they need to know that. Related party transactions, this is something that investors are extremely sensitive about, because they need to understand if there are related party transactions, then why are they so, if they are on arm's length or not. If the company owns any property, then they need to evaluate those properties. Intellectual property, of course, extremely important. Your trademark, your brand name should be in the name of the company. Even something as basic as your domain name should be in the name of the company. If you have patents, they need to be in the name of the company. What is the, if you have applied for a patent or trademark, what are the chances you would get them? So these are the kind of things that go into when a due diligence is conducted. In the initial stage, when an investor is evaluating your company, before they go completely into each and every piece, there are 5 to 6 things that investors always look at. And that is what I'm going to focus on today, which is first is the nature of entity. Most of the VCs, I mean, almost all VCs would invest only in a private limited company, period. So you cannot have a LLP. You cannot obviously have a sole proprietorship. You can only have a private limited company if you are looking for VC capital. Your cap table, which is your shareholding table, becomes extremely important, because what the investors are looking for is who all have you promised equity to. And the classic example is a lot of times startups would have promised equity to some mentor, some advisor, sometimes taken loan from family members and promised equity, could be to an accelerator or incubator. Now, all of these things, the investor needs to understand, because remember the valuation Karthik was talking about and the shareholding structure. Now, the investor thinks if they give you X amount of money at a certain post money, they are getting a fixed percentage. But once they have given you money, and once they have taken that percentage of shares, if you go to them and say, oh, you know what, I had promised 3% to my advisor, I had promised 2% to my website developer, I had promised 1% to some client or a vendor, their shareholding will keep getting diluted. And that is something they do not want. So before they come in, they want you to reveal and put on the shareholding structure anybody and everybody who might have the right to get shares in the company, because they want all of those people to be on the cap table before they come in, so that their shareholding does not get diluted later. Okay.
Excuse me, Anisha.
Yes.
We're still on the first slide. Have you been changing your slides?
I have been. I'm on the 6th slide.
We can
Can
see
you
the
maybe
cover
try
slide
and
only.
Sorry, let me just try and get a
yeah, try and reshare. Your discussion has been very interesting so far, for sure. So we're still seeing the first slide right here.
Yeah, that's funny.
Please let us know if you're switching it forward.
Okay.
Is it on a PDF or is it on
No,
a
it's
PowerPoint?
PPT.
Hmm.
That's strange. Give me a minute, please. Okay, let me try this again. Okay, now do you?
Now,
We're-
mm,
Yes, we're seeing your whole screen, which is fine.
Yeah,
Especially
I think
compared to the
something's wrong with
alternative.
my slide share. So just bear with me. Is this all right?
It's not full screen.
yeah, it's not on slideshow mode. Yeah.
Fine.
Yes, yes, now
Oh.
we're seeing that. Perfect. Mhm.
So I was talking about the shareholding structure. Now, one important thing to remember, most investors, before they invest in the company, they require you to create a ESOP pool. Okay, and that's important from an investor's perspective because they don't want to get diluted once they come in. From a promoter's perspective, it makes sense to have a ESOP pool because you want to attract talent. And these days, it's not just just high compensation and some luxury bikes or cars. Stock options do attract talent, so it's important to have a stock option pool. But as a founder, as a promoter, you need to also think through what is that percentage of ESOP pool that you want to set aside, because ultimately, when you're setting aside ESOP pool, it goes from your share, not from anybody else's. So only the founders get diluted to create ESOP pool. And hence it becomes important to understand what is the quantum of ESOP pool you should be creating. Typically, the stock option, the no-brainer ESOP pool percentage is 10%. That is what investors like to see on the cap table. But if we were to talk about a range, it could be anywhere between 7% to going up to even 15%. The percentage or the quantum depends on the kind of business you are in and the number of senior management you are looking at hiring. Like, to give you an example, if there are already 4 or 5 founders in a company, we know for a fact that at least you will not be hiring very senior employees in the beginning, because the founders would kind of take care of the key management role. But for example, if you're a solo founder, then for a fact, even the investors would expect you to hire few key senior employees in order to support you. In that case, they would expect a larger ESOP pool so that a larger chunk can be given to senior employees. Whereas in the first example, where there are already 4 or 5 founders in the company, you could probably think of a 7 to 8% as a pool, right? So, but it's important to think through and create that ESOP pool in advance. Similarly, these days, you're seeing a lot of advisors also coming in and requiring stock options. So you also need to create stock options for advisors. Again, important to understand that when you are giving advisory incentives, they are linked to objective criteria, objective expectations, and inputs from the advisors, as opposed to very broader stock incentive structure for advisors. So these are few things you need to take care of. And from an investor perspective, they will expect all of this to be clear on the cap table for them. Typically, we also see a lot of promoter loan having been given, and investors would expect that these loans are converted into equity before they come in. So that is also something you need to be careful about. If as promoters, either you or your family members have given loan to the company, you need to have loan agreements drawn out, the terms of the loan agreement drawn out. From a compliance perspective, you can't just give loan. There are paperwork required, there are filings required. So ensure that you have completed all of that and then carried out these, given out these loans to the company. Apart from that, in case you have any service provider and you have given them or promised them stock options, then even those need to be listed out here. So yeah, those are the few things that we see typically come up when an investor is looking at your cap table. So it's important to have clarity on each of these aspects. Moving on, like Karthik had mentioned in his presentation, team, the investor is investing in you, is investing in the team. So it's important for them to see that there is a team that is working full time in the company. So a lot of times a red flag for an investor is if not a single promoter is full time, right? Or if the promoters are not employed with the company. From an investor's perspective, what they are expecting is that the promoters are engaged full time only in the company in which they are investing. Second, the promoters actually have employment agreements where they are committing to, of course, exclusively working with the company, but also that all the intellectual property that has been created is owned by the company. That is key, because the value is in the intellectual property, value is in the know-how that you have developed. And if that doesn't belong to the company, then what is the investor paying for? So that is extremely important to investors. From employee perspective, investors expect that the employees also have watertight contracts, again, because any intellectual property created by an employee needs to also belong to the company, and there shouldn't be any claims in future from an employee that, you know, whatever they created belongs to them and not the company. These are typically what we see from employees' perspective and a team perspective. And believe you me, I don't have to look at any of your companies, but almost in 9 out of 10 cases, when we carry out a due diligence on a company, the 4 conditions precedent I was talking about when it comes to team members or team building, that we see every investor ask for are 1, contracts, right from founder to an intern. Everybody in the team needs to sign contracts with the company. 2, all these contracts have to be on stamp paper. Yes, we often get asked, why stamp paper? Why not letterhead? But a VC requires you to have all contracts in the company, be it employment contract, NDA, vendor contract, all contracts need to be on stamp paper. So one of the most common conditions precedent we see is
I'm
that—
sorry, Anisha, what is stand paper? Maybe it's an Indian thing or
Yes.
it's not, because it sounds like it's not. I don't know what it is. Can you tell me?
Sure. So it's an Indian thing. So in India, every time you execute a contract, you're supposed to pay stamp duty. So basically, you got to pay some money to the exchequers. So there is a stamp duty you have to pay, and you get a paper that evidences that you have paid stamp duty. So every contract
Okay.
has to have that stamp paper on it.
Oh, thank you so much.
So that is the second most common condition precedent. So if your agreements are not stamped, the investor requires you to actually re-execute these agreements on stamp paper, right? The third most common condition precedent we see is, like I said, ESOP policy. Have a ESOP policy and grant ESOPs to your employees. This is again a very common mistake most startups do. When they hire talent, they promise ESOPs in the offer letter and they think that is sufficient. They think, oh, I have written in the offer letter that I'll give 10 ESOPs. So that is it. I have granted ESOPs. I don't need to do anything. I've kept my promise. It actually doesn't work that way. In India, you actually need to have an ESOP policy first before you can start handing out these ESOP grant letters. And this is where a lot of times founders delay in doing it. And hence the employees get their grants very late, which leads to a lot of heartache. So important to have ESOP policy in place. So the third most important CPVC. And fourth is labor law compliances. So in India, depending on the number of employees, depending on the state or the city you're located in, there are a lot of labor law requirements that you have to comply with. And this is, again, one of the biggest roadblocks in every due diligence. So ensure you have your labor law compliances in place. If you're less than 10 employees, if you have less than 10 employees, you're good. Most of the compliances begin from 10 and then 20. Those are the 2 magic numbers. intellectual property is something that every investor is obviously particular about. If you have a brand name, important that you file, make trademark filings for it. If you have any proprietary technology or know-how that you have developed, you may consider patenting it. If you don't want to patent, that is also fine, because a lot of companies do not want to disclose their know-how and would rather protect it as just know-how and, not expose it. So patenting is not mandatory, but if you do decide to go for it, then it's important that it is in the name of the company and not the promoters. Corporate compliances, the biggest problem in any due diligence. As a startup, when we start up, we are just focused on building traction, getting our business model right, getting funding in. We're just focused on hustling. And as a result, we do not actually pay attention to compliances. And these are the ones that actually come back to haunt most startups during the process of due diligence. If you don't have your corporate compliances in place, it just, see, one is trying to fix it once you've identified it, but a lot of times you cannot fix a lot of things. So that will, any non-compliance, and there are non-compliances in India, which if you have not issued shares properly, or if you have taken loan from someone you shouldn't have taken, the penalties go up to almost 2 crore rupees, right? So these things keep haunting you forever. In every due diligence, the investors bring it up, and ultimately they expect the founders to actually stand behind these non-compliances and commit to the investors that if tomorrow there's a penalty, then the founders will be personally liable. So any non-compliance will come back to haunt you, not just because it will delay your due diligence process, but also because you as a founder will always be personally liable for any penalty that comes out of these non-compliances. That is why it is in your interest to ensure that you have your paperwork in place. And don't just, I completely understand when in the beginning someone's offering you money and says, here's my money, figure out what you want to do, like whether you want to give me shares, whether you want to return it with interest later. Doesn't work. In India, that doesn't work. If you are taking money from anyone, friends, family, investors, whether it's a loan, whether it's investment, ensure you have checked with your consultants and gotten your paperwork and filings in place. Because if you don't have that, you can't undo it later. It'll only add to your non-compliances and your personal liabilities will increase. Similarly, in case of contracts, like I've already said, you need to have employment contracts in place. You also need to have vendor agreements, depending on your business model, right? But the idea is if you are dealing with, if you're in a B2B model where, you're only dealing with businesses, you still need contracts. Your contracts need to be watertight. If you contracts with customers, contract with vendors, suppliers, consultants, all of those need to be watertight. What investors look for in those are how much risk exposure is there. So how much of most contracts have something called indemnity, where you commit to your client or your vendor. If something goes wrong, you will make good that loss. And that is something that worries investors. That kind of exposure is a financial exposure for the company, and investors don't like it. So it's important that your contracts are properly vetted. And of course, all of them should be on stamp paper. That's the end of my presentation. Does anyone have questions? Thoughts?
Yeah, hi, Kanchim, this side, I have a question.
Yes.
So, at the starting of, registering the organization or company, we have taken help from like friends. So, do we need to have like what kind of like compliances, security compliances, any compliances we should have taken care of? And these we were talking about very less amount, like 1 lakh or 2 lakh rupees.
Yeah, it's not the quantum, right? The question is, you have taken money from someone. The question is, how have you recorded it? Because the first thing is, as a company, you cannot take loan from any individual, okay? Unless that individual is a director in the company or a shareholder or an immediate relative. When I say immediate relative, it's only parent, sibling, spouse, and children, right? If you have taken money from anyone outside of this circle and who's not a director or shareholder, you could not have taken, right? That money without having either shown it as service fees, like if you've provided them service and they've paid your fees, or it is an investment. If it is an investment, then the challenge is you should have given them shares, right? So you need to kind of go back, see what your accountants or auditors have recorded it as. And we can take this offline, but we need to fix that, because it's not the quantum, because ultimately all of these keep adding up. And like I said, you can't undo these non-compliances later on. So if you have identified this as a problem, let's find a solution and fix it. And of course, a lot of it, if you have already gone through audit and the auditors have recorded it, a lot of it will also depend on how the auditors have recorded it. What have they recorded it as?
Right. Sure.
Hi, this is Gaurav from Orgro Fiber. Ma'am, I have two questions. One is that, our patent which we have filed, it is between the government of India and the Orgro, which is our company, our startup company, and it is in a joint name. My personal name is there, and the company name is also there. And similarly, the department of the government of India and the government, that particular, the director's name is there. So will it be a valid thing? And second question is, second question is, we have received some fund grant kind of a thing. So how should we record in our this account? It's in a grant money, not on a loan, and not neither in a kind of any credit from any individual. So it's in a grant money from government. So what should we show in our books of account?
Karthik, can we stop recording? I can't answer questions like this.
I'm not immediate. You can.
Yeah, sure. But on the first one, and even Karthik will tell you this as an investor, because Karthik and I did go through this with another company that we were evaluating for investment. At some point, the patent being also, so the co-authors of the patent are also the government, right? And that is where when investors come in, they want a waiver from the government or the co-author, because they want the startup to have full ownership. See, one is you being a co-author. That is easy, right? I mean, we can always get you to give a no claims and all of that. You can always assign the patent to the company. The challenge is getting the government to assign the patent to the company, because what worries a investor, and if this patent is core to your business, right? What worries the investor is that somebody else has part ownership of that patent, right? And that is where they don't know how that will play out in the long run. They don't want to be in a situation where they give you money, they give the company money for that patent when that patent is not fully owned by the company, right? So which is where investors would require you to typically get a assignment done from the government to the company, one, or second option, get like a waiver or a no claims letter from the government saying they are okay, they will never claim anything against that patent. But investors would want that assurance.
Anisha, you may like to stop sharing your screen.
Sure.
Yeah.
On the grant thing, I can take it offline. I think I can share my email ID. You could set up a call with me, and I'm happy to kind of answer the question around that.
Thank you so much.
Thank you for this. Yeah.
We have Amshu, Kapil Dev, and Amlan.
Yeah. Hi, this is Amshu here. I'm from the startup called Tapasu Foods. We are registered as LLP. I have a question in terms of the employee agreements that was mentioned on the the bond papers that you were talking about. So when we started off, we work with a lot of interns, right? As a startup, we work with a lot of students who come in as interns, and there is offer letters and NDAs that are put in place, but none of them have been put. The earlier ones have never been put on a bond paper or a stamp paper. So probably from now on, the best practice that we can do is follow what you mentioned. But what about the previous ones? How can we account all those things? That's my question for you.
So, like I said, you'll have to get them re-executed because that is what any investor will expect, right?
Okay.
You don't do it, unless they will take an indemnity from you for not stamping it. So you don't want that on record. Rather buy just 100 rupees stamp paper and get these re-executed. That would be far more simpler for you.
Okay, got it. Thank you so much.
Okay, I am specifically with each passing day, the life of private limited companies is becoming harder and harder because of the new rules, additions. Only a couple of days ago, the new documents have been opened up by MCA. And every time we have been, of course, our CA and CS, they are really trying to understand these documents, and then the deadline passage, and then we have to pay a heavy penalty. So things are really becoming difficult for the private limited companies. So can you help us? How can you guide us how to come out of these traps? Rather, I'm using the word trap.
Unfortunately, sir, there's no way out because for a LLP, it's even worse right now. Filings. See, it's just teething problems.
Private limited company. I say private limited company.
No, I know. But the other option is LLP, which is what I'm saying, right? It's frying pan to fire. We are actually right now, we are going through a teething problem because the government is upgrading the platform, and hence, unfortunately, startups and companies are kind of paying a penalty on it. But over a period of time, hopefully it will just become seamless. But unfortunately, when it comes to government interface, while we can guide you, we can't anyway change anything on the platform. So we'll just have to kind of bide our time on, go through when the platform is going through this transition. It's a question of another month or so, hopefully.
Okay. But then the 30th September is the last date for KYC. And now the director's KYC, still the rules are not clear. And then we have to pay.
No, I think that is clear. See, unless you're changing anything in your KYC, it's pretty simple. I've shared my email ID. My colleagues can help you on that. Unless you're changing your KYC details like address, etc., it's a fairly simpler process.
Okay, every time we have been paying 5,000 rupees penalty for his director. Anyway, thank you very much.
I think someone has asked if we can elaborate on Leela has asked if we can elaborate on term sheet terminologies. Actually, that's a separate topic by itself. I'm happy to talk about it, but I mean, Karthik, Ashna, it'll have to be a completely separate topic, right? I can't go through.
Yeah, of course. Tanmay, you want to unmute yourself and ask a question?
Yeah, thanks. Anisha, thank you for the great presentation. I just had a question around the IP. So do investors during the DD process also expect the startups to reveal their IP to them? For instance, doing a thorough review of the code base and checking all the algos that we have. So in that case, if that happens, how does a startup protect its IP? For instance, let's say the deal doesn't go through, but you would have already done and showed them the entire code base.
So typically investors don't go through your entire code base and don't review that. They don't expect you to also reveal that. They do a thorough IP due diligence when there's a patent, for example, right? And the entire business is hinged on this patent, for example. Then there is, then the patent specialists are brought in, right? But if it is just a tech-based business, for example, they don't go into a full code review. Karthik, you may want to add there.
I think it's just a question of the level of trust the investors have. You get so many different types of investors, right, Amlan? So if they come from a software background, then they might strongly believe that the value they have is to kind of look under the carpet and be able to evaluate to the last bit of code, right? So it's almost like a micromanaging investor to me. So I think it's a relationship-based thing. So if you really trust them, you can have them look under the carpet. But if you also think that they don't really trust you and that's why they want to do it, so it's a pure trust relationship-based thing. So obviously, get your NDA on stamp paper. But at the end of the day, I would push back and kind of evaluate whether the investor is qualified to even evaluate the code base, right? First and foremost. So it's a very good opportunity to evaluate your investor. I'm sure you get consultants who help you with like improving your code base or working with you on your code base. So think of it in the same way, right? If they think they are qualified, then maybe it's an opportunity to build relationship. But make sure they show that they are qualified to do that.
That's true. And see, we do about like almost 80 deals a year, of which almost, I think 70% of them are tech startups that are fundraising. Don't see code reviews happening.
Great. Thank you. Thank you, both of you.
This is Gaurav again from Orgro. A small question. We have a third-party production and we have signed an MOU with them and not on a stamp paper. So I do understand that, the stamp paper is a bigger requirement. But will it be okay if we keep it that third-party on a MOU? Will it be okay, or we should have to go for a legal stamp paper kind of a thing?
See, stamp paper is, look, this is purely checking the box from DD perspective, okay? Not stamping a document does not make it unenforceable, right? So MOU per se is enforceable. It is just that from a DD perspective, the investor expects you to have it on stamp paper. If you don't have it, they'll just simply, at that point of time, require you to have it on stamp paper. So my suggestion is wherever it's possible, buy 100 rupee stamp paper and just put it on top of the contracts.
Sure. Thanks.
Amlan, you have a question?
Yeah, ma'am. I have just two small questions. One is like, if the IP, we have an IP which is owned by the founder much before the company was founded. So do we have to do anything with that?
Yeah, sorry, when you say you have an IP, is that a trademark or a patent or design? What kind of?
It's a published patent.
Okay. And that is the core to the business of the company?
Absolutely.
Yeah. So the IP will have to be assigned, the patent will have to be assigned to the company. So you'll have to do a patent assignment agreement, and there's a full process in order to complete the assignment. Any patent specialist will be able to help you with that.
Oh, so this is called patent assignment to the company.
Yes.
Okay. See, I mean, other is a very stupid question, but since you said that loans given to the company, so it's like the founder's salary, is that also a loan to the company? If you have not withdrawn salary?
If you have not taken the salary, you're saying?
Yeah.
No, that'll not be considered loan.
So that is an investment.
Considered outstanding liabilities.
Okay, thanks. That's...
Any more questions for Karthik or Anisha?
Anisha, do you have still the early DD checklist that you could maybe share with the group?
Yes, we'll share that.
Right, and I have 3 asks. So I think the term sheet is obviously a very specific one. I ideally kind of, I can maybe share a few reading material, and Ashna can do that. We've gone through that multiple times for you to kind of understand what goes into a term sheet, but you really want to get a lawyer when you're kind of going through a term sheet. That's my biggest advice. Don't try to figure out a term sheet by yourself. It's just not worth it. The two other questions were around valuation, and then the other one was around parameters that we need to think about. So the parameters usually for us is typically metrics or KPIs that are linked to businesses, right? So every business model, every sector has different metrics and different KPIs, and those are very often linked to your valuation, right? So, and every type of business has that, right? So, and you'll read that even when you're reading the news, so Flipkart and like, you know, Big Basket and all that, it's like gross merchandise value that they are shipping through, right? SaaS businesses are like monthly revenue run rate and annual revenue run rate and cost of acquiring customer CAC, right? So each type of business, and that's also for land restoration businesses. So it can be based on like, you know, customer retention, you know, it could be based on, you know, kind of your standard metrics, which are your EBITDA, and EBITDA is very specific to the type of business you're in, right? The asset turnover ratio, or, you know, so different ones. And till we kind of work through your financial model, you can't get there. But I think that's something that we can take up alongside talking about valuations.
इतना कम है. Anuja, can you please mute yourself?
I think she got an auto. Okay, so any other questions?
Ravinder has his hand up.
Yeah.
Yeah,
Thank you so much. First of all, I would like to thank Anisha and Karthik, both of you, for giving us very good information on due diligence. But I just wanted to know that, Karthik, the question is from you, whether we can get a chance for a mock pitching to you. Actually, is there any possibility actually to understand? Yeah.
Yeah, sure.
Sorry. Also, Ravinder, we will be conducting mock or pitch practice sessions during September and October. So Karthik can also, I will make sure that Karthik attends the one that you're pitching in as well, so he can give his feedback.
Yeah, but because actually the Karthik seems to me the one who can actually give me the right perspective, because others, mostly the VCs are very sort of like harsh sometimes, not even reply anything when you pitch to them. So they just sit back muted. So I just want to hear where I'm right, where I'm wrong. Give me feedback, because I'm here for the right purpose. I'm here for the right business, right? And I'm doing it that way, but I need to learn where I'm wrong, right? So that I can correct myself and go to the right perspective.
Have we already had a pitch session, like as in like setting up your pitch deck, designing your pitch?
Yeah,
right?
so Looney took that. Looney took that already, but we'll be having pitch practice sessions during September and October.
Okay.
In October, Ashna.
Sorry, in October then.
Yeah.
We'll be having pitch practice sessions for the top 15.
All right. So I think, Ravinder, just again to where I started, right? You got to find the right investors that are excited about your business, right? That's the biggest thing you need to do. And when you find them, you got to get them excited through a pitch, right? So I think the bit that you can do is basically first maybe network with some of the startup founders who are in similar businesses to yours and who recommend investors. So obviously, you have me, but other investors, because I think the hunting for investors, pitching them, and a lot of times don't have to pitch the business. You just want to kind of say, hey, if I told you about my business, can you give me feedback, right? Don't ask for money, just ask for feedback. And you might actually get it, right? So a lot of investors may not want to say nice things because they think that saying nice things would make you expect that you're going to kind of get an investment from them, right? So it's all very tricky, so don't worry about it. My biggest recommendation is go network with a few of the startup founders who recommend investors. Talk to some investors in your region close by, because then they can't run away. You can meet them often, build some rapport with some of these people who can then connect you to others as well, right? And then obviously having a good short pitch, long pitch would be good. So we can work on that together.
Yeah, actually, it'd be very nice if we can actually get a list of VCs who are a little bit more socially oriented.
Ravinder, we can take this offline sometimes later. So
Yeah, sure,
let's
sure.
keep the questions focused on the theme of the session.
Okay.
And I think we are already running over time. We are grateful to our speakers who have put so much hard efforts and have really shared this insightful presentation and also a very interactive session. I think in the interest of time, we don't have the time to take up more questions. And thankful to Anisha that she has already shared her coordinates. So people who have any specific questions, they can reach out to her or to Ashna. We are happy to coordinate. And finally, I would like to extend my heartfelt thanks to Anisha and Karthik for taking out time for this really important session for all the entrepreneurs, not just the restoration ones. And we were really looking forward to organize this session. And now looking at the kind of interest which people have shown around the valuation, the term sheets and all. So we are looking forward to both of you, Anisha and Karthik, for hosting a session in the in-person impact days. We'll reach out to you and we'll plan accordingly. So thank you so much for joining us today. And I would like to pass on to Amanda for her closing remarks.
I don't have so many closing remarks. I never really do, but thank you guys so much. I'm really excited to see the turnout for this event. I think that we learned a lot of different topics. We have some notes available on Mighty Network. So again, posted a link if folks here haven't been a part of our top 15 Mighty Networks, you can join it. And we'll have recording and PowerPoint presentation up. So I want to thank Anisha and Karthik in advance for their PowerPoints, but also thank them for the immense knowledge they shared with these really, really worthy entrepreneurs who are here. We had mentorship with all the entrepreneurs, and we are actually moving into the section where we will have a pitch practice as well coming up. So look out for those invitations coming soon. I think that's all for me. Just wanted to thank everybody and give big gratitude to Karthik and Anisha. Thank you so much.
Thank you.
Thanks, Anisha.
Thank you, Anisha. Thank you so
See you
much.
again soon. See you again soon, right? We're gonna do the tip sheet now.
Done.
Cool. Awesome.
Okay. Thank
Thanks.
you.
Thank you, Anisha. Thank you, Karthik. Thank you.
Thank you, everyone.